So if you are ready, Wade, I'll give it over to you.
Cool. Thank you very much, Durant and team at Blignaut. I assume you can see my screen and hear me correctly, so I'll proceed as normal. Thank you very much for the time to present to you this evening, and thanks for joining us on the call. I'm coming to you from sunny Cape Town, but if you hear a bit of noise, please excuse, because the Cape Doctor has made an appearance at the start of the spring season, so it's a bit windy here today. Also, please just forgive me if my eyes revert down to my phone, just to ensure that I'm within your time this evening. So once again, thank you for joining us, and thanks to the team at Blignaut for the warm welcome. My name is Witbooi. I'm a portfolio manager for Glacier Invest, and the team that I work in looks after the Blignaut portfolios, the wrap funds that we look after as an investment committee, as well as the newly launched real income solutions that the Blignaut practice also has access to. And this evening, I hope to give you a little bit more information about how we're tackling the problem, how we're building portfolios, and how we're going about to explicitly improve lives of our investors and improve outcomes over the long run. So about Glacier Invest, currently we're the largest DFM or discretionary fund manager in South Africa. So over the past few years, our business has grown quite remarkably due to the support and buy-in from advice practices like Blignaut BlueStar and team. We are extremely client-centric, which is the purpose for this webinar, and I'll explain why a bit later. Fiercely independent, we have purposefully active portfolios or manage portfolios actively, and seek to offer as much holistic support to our clients, so that in turn they can offer you holistic financial planning throughout your investment journey. Our product set, our offering to market, in our view at least, is unrivaled. It is customizable, and our fees that we get access to some of the most superior funds in the country are unmatched at this stage due to our scale. So that does allow us to pass even more benefits through to you as an investor. The portfolios we look after ranges from traditional local portfolios as well as global portfolios. So I've just put some of our global portfolios on the screen at the moment, which we're quite excited about and taking out for SA investors who have hard currency, be they dollars, pounds, euros, who are looking for some sort of vehicle to invest for the long term. We offer solutions for those portfolios too, and this is something we hope to talk to you a little bit more about in the future. With regards to how we see the world, we try to be very explicit in how we do things. So it's one thing for us to be an investment team and claim to be gurus, to pick stocks and funds and sound really smart. But at the end of the day, we need to realize that it's people's money that we look after, that they've saved for many years, and that's really close to them. And we need to do our best to look after it in terms of risk, but more importantly as well, to get a sufficient return for the risks we expose our clients' capital to. We see our clients largely in terms of this journey, and it's a journey I'm sure you are familiar with, whereby there are certain stages in your life where you accumulate wealth and you can contribute as you're earning an income, whether it's a retirement annuity, a tax-free savings account, or even discretionary investments that you put aside on a monthly or annual basis for that one day, be it retirement or use. So when we look at product, we like to isolate whether it is for accumulation or whether it is for decumulation, or whether it's the point in time where you need to start to take an income and let your capital that you've saved so hard start to work in turn for you, start to earn you an income when you aren't earning a traditional income. So we try to be very specific, and the portfolios I'll discuss to you this evening are way more focused on the decumulation journey of an investor's life cycle, as opposed to the saving and the buying and the capital growth side, as always is. So within the unit trust industry in South Africa, the landscape has changed dramatically. We've seen a proliferation of funds and asset managers being launched over the past decade specifically, as the names you know are no longer the front runners within the investment industry in South Africa. So just because an asset manager has a huge budget to go out and buy advertising at an airport or a mall does not mean, in our view, that they are the most superior. Our job is to go out there and scour all of these 2,000 available options for you to go and find the superior funds and strategies to go about earning your long-term returns for your client capital. So at the start of our assumption as an investment team is because there are so many funds, we believe as a starting assumption that skill is there, that not all of those 2,000 funds are going to outperform, and not all of them are going to do so because of skill, because a fund can outperform because of skill, but equally it can do so because of luck. So if only the finding the needle in the haystack was as easy as it is on the image on the left, however, our job is more the image on the right, to really go and look for the little needle in this big, huge haystack. I like to look at it a little bit differently. So you could ask us, go and find me a nice wine, and then send us into macro. And you walk into macro and there's just tons. Where we come in is trying to isolate the selection to make sure that we do our work to go and find the really specific instrument you're looking for. In this instance, it's a needle in a haystack. In my example, it's a bottle of wine which meets your budget and your taste. And in the investment portfolio, it is a fund or a strategy that delivers upon the outcome you are looking for from your hard-earned capital. So when we do manager research, we like to split it into a quantitative view and a qualitative view. So quantitatively, this is where those typical images of screens and red and green graphs come about, where we need to slice and dice the numbers from a quantitative perspective to find the superior managers and funds to put into your portfolios. Qualitatively, we then need to go and actually kick the tires at these businesses to ensure that the investment professionals managing your money are astute and on top of the game, as well as operationally their businesses are doing so above board and everything is clean, and also that the investment process is repeatable, so that it wasn't an outcome of luck completely. In that, in our assessment, we can try to find whether there's actual skill in this manager, and that could be whether he's a large asset manager with fancy advertising in the airport, or perhaps a lesser known one who is more passionate, who doesn't really care about having advertisements everywhere, but who really just wants to generate the best return possible for the investors. We believe that's where we come in. On the right-hand side, we try to find what we define as the style beta, as how does this fund capability perform in different market cycles, because there are many funds, some of which are similar, but really the same. So it's perhaps an example is trying to find a rugby player, where you can find a set of rugby players who all play on the wing or all play on flank, but they all have different abilities, whether they need to clear the ruck or need to fetch the ball, whether they need to be strong or they need to pass the ball, whether they play on the wings, whether they need to be fast, whether they're cutting in, sidestepping, or whether they're actually helping to defend as well. This is where we need to go and differentiate between all of these different strategies out there on your behalf. Now, firstly, the picture on the left isn't me, that's just coincidence, but the graph on the right is the one I'll be speaking to today. We're going to focus on the decumulation phase and these post-retirement products or post-retirement portfolios that we have been working on so far behind the scenes. As Diran said, this is, in our view, a first in South Africa that we are trying to blend the best of what we already know here and introduce something new which has never been done. However, I'll show you which has been in existence in global markets for the past few years. So within South Africa, the retirement challenges are vast at the moment. If you look at the savings pool in our country and what the income need is from that savings pool for our population, it is clear that withdrawal rates or the incomes that clients are taking is way too high relative to the amount of capital, which leads to two outcomes. So either we need to be time travelers to go back in time to increase contributions and compound them to retirement, or we actually need to reduce incomes, and that's a really hard conversation where we need to ask clients to buy half a loaf of bread instead of a full one. Our job is kind of in between, to make sure we can make the best of what's possible of the assets we have and try to grow them as consistently as possible. Secondly is longevity. People are living longer. I think that will be obvious to see. I think my great-grandmother lived to be 95. My grandmother is 90 and much more healthier than my great-grandmother was. And probably much like all of us, I'm going to have to look after my parents probably until the age 100 as well. Medical advancements has made this possible, as well as better lifestyles. And this is actually becoming a burden on society, on the savings pool, and the investment industry. I think a good example is in Japan, where they have such an aging population that their GDP growth, the productivity of the economy, actually cannot get going because there aren't enough young people to be creative, to fill the jobs, and to keep it going. So that's one challenge that we have thematically around the world, as well as sequence. So if you retire or you invest or you save today, doesn't mean that the same outcome can happen tomorrow. We don't have to go back too far in history to determine that sequencing or a fast-changing market environment can materially change your outcomes as an investor. So last year, 2020, was quite a wild one. If you invested money in February or in March 2020, your returns would have been significantly different. Even though it's a very short space of time, markets fell on average around the world between 20 and 40%. So if you were lucky or unlucky, that's one of the things we try to avoid, specifically when you are in retirement phase. So within South Africa, I did mention the longevity risk, or the life expectancy that's increasing. So the bottom line is South Africa and the average life expectancy over the past few years, and the UK is the line on top. And we tend to believe that this segment of the market, our investors that we deal with, more tend to be of developed world nature. And you can see South Africa on average is playing catch up with developed worlds, in that our population is living a little bit longer. There was a little bit of a dip in the 90s as HIV and AIDS really became prevalent in this country. But now through awareness, as well as medical advancements, we believe the trend will continue, and that the average South African will continue to live longer. Sequencing risk is what I mentioned previously. So whether you invest today, tomorrow, or yesterday, you throw yourself basically at the risk of markets, whether it's a good news day or a bad news day. We try to avoid all of those and kind of look through it, because this graphic actually sums it up pretty nicely. It's called the floor of averages, where there is an investor or a statistician who looks to cross a river, and he says, it's fine, I'm 6 foot tall, and the sign on the side says the average depth of the water you see is 3 feet. So he thinks if he's 6 feet, it's 3 feet of water. On average, I can walk straight through it, I'll be fine. But as you can see, it's 1 foot, 1 foot, 1 foot, and then it's suddenly 12 foot of depth, and then goes back to 1 foot, 1 foot. This shows you that the average is not really something that tells you the whole story, because just like in this instance, there can be a lot of volatility on the journey across the river, and this is something as an investment team we take really seriously. So illustrated otherwise, these are 3 lines or 3 investors, a normal growth chart you see over time, and you can see their starting point and their end points are exactly the same. So if we look back and say, okay, the average return for these 3 investors from the start to the end is the same, they all earned, let's call it 10% per annum, fine, you'd say they're all the same. But if you look at how these investors got their returns, you can see they are materially different. And being cognizant of the risk we take to get these things is something very close to our heart. And just as a joke, one thing I saw when I was pulling these graphs is that it ends up looking a bit like a fish. So if you think about the start to end, it kind of ends up being this fish graph in terms of the points are the same, but how they intersect through time is completely different. An actual example is we've taken a set of investors through a period of time, let's say 10 years, running from Sean, Imran, Patrick, Cindy, Dean, Johan, Francis, and Liesel. Those weren't random names. Those are the people in the team at the time. You can see on the years labeled 1, 2, 3, 4 until 10, each of them experienced a different return. But the column on the right, the CAGR, the compounded annual growth rate for all of these investors were the same. Similar to the previous graph, if all of them invested 100 Rand at the start of the period, all of them will end up with the same 6% return at the end of the period. But as you can see, the sequence of their returns are all materially different. So I think the mood in the room will be very different if these guys were all together, even though they all got the same return at the end of the day. Even more so, even though they all got the same return, once each of those investors starts taking an income from that return string, their income level, however, completely changes, because you can get lucky and get all your investment returns right on top, like Dean did, or you can get unlucky like Francis and have all your bad experiences up front. Even though you have the same return, the same income, your outcomes can be very varied upon randomness. And what we try to do is counteract that as best possible so that there aren't these huge swings within your hard-earned client capital. So what we do is try to be explicit about the world. We look at it in terms of asset allocation, so trying to determine whether there's value or scope for investment returns in things like South African equity, bonds, cash, property, credit, linkers, and we do so globally too. We've got an internal strategic strategist team that looks at fundamental valuations on all asset classes and builds up expected returns based on where they are today. So if we think it's a good time to increase offshore positions in portfolios, as we currently do, we will gladly start to reflect that. So as an example, the biggest positions in the income portfolios at the moment is SA bonds to anchor some stability locally and global returns as well, mainly in defensive assets to benefit should there be a weaker rand, as well as compound slow returns offshore. The efficient mix is what we do explicitly, and I'll chat to you about our optimization method that we do across these portfolios. We determine the risk reward per client, per mandate, or the liquidity requirement that you have, or how much income you need from your investment, and we tie it up into portfolio construction, which is basically a combination of all the things we've discussed so far. So what we do is we seek asymmetry explicitly, which means your experiences of bad outcomes and good outcomes should not be symmetrical, because that symmetrical distribution is actually a tax on returns. Volatility is a tax on returns. So what we try to do is reduce that and say, we are going to try to seek asymmetric strategies, which actually shifts the odds in your favor to have asymmetry of less downside and actually decent upside in your portfolios, so that we can firstly protect your capital should there be market movements, as opposed to just chasing as many returns as possible. And the quote sums it up nicely. So risk is like fire. If controlled, it will help you. If uncontrolled, it will rise up and destroy you. And that was Teddy Roosevelt. So in this instance, number one, risk is defined as not having enough money. So I've not saved enough money, and that's my biggest investment risk post-retirement. Secondly, capital losses and volatility are a second risk. It's actually a tax on your returns, if you think about it over time. And number three, asymmetric returns can actually maximize your probability of success by actually trying to explicitly and slowly tilt the odds in your favor and cut off all those hard experiences as best possible through the cycle. And how we do this is just with explicit mandates to managers. So if we like a portfolio manager or an asset management house, big name or small name, we'll tell them explicitly, we'd like for you to deliver that green line that you see through time. Not only because it outperforms, but that's just a function of the start and the end point. So I wouldn't look to outperformance, but what we do want from them is to outperform the index we give them on a risk-adjusted basis, so that should this index or should the market fall, we want explicit protection from those bad outcomes, and should markets recover, all we want to do is participate a little bit. We don't even need the full protection. So as the graph says, 1/3 of the downside, 2/3 of the upside can leave us in a position where we get the same return, but for exceptionally lower levels of risk or variation in our monthly returns. And that's what we try to cut off. If we display that differently on a statistical distribution, all you can do here is focus on that blue or purple line compared to the yellow one. This basically takes a range of outcomes over time, and you can see it ranges from, let's say, -10 to +10 on a monthly basis. And that's how quickly markets can move. And you can see that the yellow line is largely flat in the middle. So there will be bad times and there will be good times. And we cannot really say when they will happen. The purple line is what we actually try to achieve and have done so through time, in that we aren't really willing to participate in those -10, 8, 7, 6, 4s. That's not an ideal outcome for us. But that, obviously that doesn't come at no cost, because we can't just say we want no downside or upside. As you can see, our portfolios are really not expected to return in those roaring bull markets as well, in line with the market. But what we want is that middle section that you see, where the outcomes or the distribution of outcomes are far more consistent for your capital. This is what we, in essence, try to quantitatively achieve through these portfolios. So if we just take a step back and look at the world of asset management from a global lens, what I've done here is just taken the average asset allocation, or how investors invest their money, from a global perspective. So this is from the UBS Global Family Offices report in 2020. I've taken family offices globally because primarily family office institutions seek to protect capital and actually try to isolate volatility and not really chase maximum returns. They're trying to protect what they have and grow it slowly through diverse income streams. So this is actually a bit of a window into how US or global investors actually invest high net worth individuals' money. On the left-hand side, you can see it starts with a bit of a split, 60% traditional assets, and then 35% to this thing called alternative asset classes. On the traditional side on top, you can see largely it's still in equities like the all-share index or the S&P 500. There's fixed income or bonds, and there's some cash. And that goes to developed and emerging markets, so things like the US, Europe, as well as China, Asia, India, Indonesia, etc. The bottom block, however, is where it gets interesting, because these investors have access to something that not all investors do have access to, and those are alternative asset classes to generate returns. Things like private equity, things like real estate, as well as hedge funds to go about generating returns for investors. You can see this can be via direct investments or indirect investments. It can be listed instruments that trade daily, or less liquid that actually take a number of years to invest. So globally, this trend is actually in place firmly at the moment. And for capital preservation and growth within this product set, we believe this trend will persist in South Africa, which is why we're trying to come to market first and invest your capital at a global standard. This is a survey done once again on family offices globally and what they intend on doing with portfolios. So on the top left, how do you anticipate your allocation to alternatives changing over the next 10 to 5 years? And you can see it goes from significant decrease to significant increase from 1 to 5. And you can see the measure there largely in the middle, 46%, but that outcome actually leads its way, 42 and 7, to those investors increasing their exposure to alternatives in their portfolios. Similarly, on the right-hand side, we see the same trend within hedge funds, with global investors seeking to increase their exposure to hedge funds to generate returns in highly dynamic markets. And the last one below, where it actually has been the biggest or most convincing growth, has been how do you anticipate your exposure to infrastructure changing in the coming years? That's been the biggest trend. And I think you would have seen in the media as Sanlam, we have also launched an infrastructure fund, something that is going to be impactful and actually help rebuild our country. And for that, we have raised capital successfully and are looking to invest in companies who are going to help rebuild our country, the roads, the bridges, and even put up some windmills outside of Tilbach. They're already starting to use the capital we've invested to put up some windmills to generate electricity so that we can be more sustainable. So within the portfolios, we manage in combination with our partners, and we have available to you via the Blignaut team. Half of our portfolio, or 50% of it, sits in traditional strategies, and these are balanced funds, flexible funds, equity funds via companies that I'm sure you are familiar with already. And the second half of your portfolio, much like global investors, we are looking to expose to alternative asset classes. Things like hedge funds, smoothing portfolios, as well as alternative asset classes, be they private equity, unlisted credit, unlisted property. The solution itself will appear as it is at the moment. A portion will be traditional CIS funds, so those are collective investment schemes or normal funds. We introduce retail hedge funds, which we take into market quite aggressively via our Amplify business. We also have smooth growth portfolio, which is where we take a normal balanced fund, but try to strip out as much of the volatility as possible and give you a matched return, and I'll show you what that looks like, as well as our newly launched multi-strategy alternatives portfolio, which is a first in South Africa, which we actually got opened last week for new investors. So the alternative bucket, as I've said, sits between hedge, smoothing, and alternative asset classes. And as the top line says, we believe these sort of tools allow greater asymmetry, because some of these strategies are really not linked to what the headline may be on the day, or whether it's COVID or political crisis or global supply chains. The way in which they generate returns isn't reliant on traditional means. So they do allow us to actually get a better return and actually complement the rest of the portfolio adequately. So I've mentioned the smoothing portfolio and what we try to do there. And this is a basic risk return scatter. So on the horizontal axis is the level of risk or standard deviation that the asset is exposed to. And going from bottom to top is return, so reward. So what you want to do ideally here is be as close to that top left as possible, meaning the lowest return and the highest possible, or the lowest risk and the highest possible return. We know in theory that sounds great, but in practice it's really hard to do and do so consistently. But what I have highlighted here in the crosshairs is that blue dot, and that is our smoothing portfolio. And as you can see, I've highlighted on the right-hand side some of the gray dots, similar strategies that target the same assets. But what we do there is, because we have an explicit formula to remove volatility, we seek to give you the same return, as you can see there, for less than half of the volatility. So the swings on a monthly basis in that portfolio are not as wide as a traditional fund, and that's one way we can secure a bit of smoothness in your portfolio. Another way is hedge funds, and these are some of the managers we use. These names were new to me at the time, and I'm sure they will be new to you as well. So on the right-hand side, we invest in hedge fund managers named Marble Rock, Acumen Capital, Terebinth Capital, as well as Matrix Fund Managers. So while there aren't common household names, these are some exceptionally skilled investment professionals who are happy to manage money without going to put up big billboards everywhere or look for assets. The graph on the left just basically shows you in the yield curve space, there is adequate diversification from our blend, because the managers I've mentioned invest from the bottom or the short end all the way to the long end of the curve, and that allows them to make money in fast-changing markets, regardless of whether bonds do well or poorly on the day. They can go and find opportunities whether it is a good or bad day on the market. And consistently, our lineup has produced some of the top awards in the Hedge News Africa outcomes every year. So on the alternatives side, or the private equity, and I'm conscious of time, we aren't investing in private equity at the moment on the top left, but naturally this is something over the course of time which we will gain more interest in. The liquidity there is it's a bit more tied up. So if you're a private equity investor, you have to invest capital and then be comfortable not accessing it for, let's say, a period of 5 to 10 years. And because you and other investors need a monthly income, that's not a risk that we can take at the moment. So that also goes into our process. Will the investor not be able to disinvest? They have liquidity. So the portfolio that we've actually launched does provide for that. It's also very unique in that we can actually, because we're part of Sanlam with a huge balance sheet, provide liquidity so that if anything happens, we can fund portfolio needs and income requirements. And the third myth is private markets are very risky. I wouldn't say it's very risky because there's risk in all asset classes, but what we want is superior risk-adjusted returns. So for the risk we take, we expect a certain return. And in the data we've observed, this asset class does give us that. It gives us a much lower volatility profile. And because we invest for a much longer term, we have a higher expected return from these asset classes. So again, a very complex chart, and I apologize if it's a bit vague, but this kind of is the crescendo of what we try to do. The lines you see are those distributions over time and how the outcomes change on a month-to-month basis from minus to positive. So what we try to do is evolve these portfolios, and that's how the line starts to tick upwards, closer to the middle, closer to consistent returns. We try to reduce or remove outcomes on this side of the spectrum or those negative experiences in your portfolio and try to give you a stable return with decent upside participation. But it's really explicitly trying to ensure that your capital will be there for as long as you need it. So to bring it all together, the Glacier and Blignaut Income Solutions seeks to manage risk, enhance return, have an exceptionally diversified portfolio. What we do is we use CVAR portfolio optimization, which is conditional value at risk, which helps us cut off left tails or sharp market drawdowns as far as possible to try and let you get compounded returns through multiple sources of instruments within your portfolio. The income range is vast, so from a 2.5% requirement all the way to a 6% requirement, and higher than 6% we don't think is a sustainable income level. So we just play where we can get returns realistically. So in conclusion, thank you once again for spending the time with us this evening or afternoon. We think new thinking is required to solve this problem that's facing investors in South Africa. Solving the sequencing problem, so the randomness of when investors come into markets is something that we can focus on. Using all tools at our disposal and trying to have a little bit of new thinking for new times and keeping our tools sharp as best possible. Because in our view, successful investing is about managing risk, not avoiding it. But just because you want returns doesn't mean you have to take no risk. But our job, as well as the team at Blignaut, is there to make sure that any risk we take is being managed and is in line with your long-term outcomes. So I hope I've been able to provide a little bit of context as to where we fit in, how we look after your money, and the steps we are taking to grow and compound and stay relevant in this industry. So from my side, thank you for joining us. Thank you to the Blignaut team, and I'll hand over to Durant if there are any questions at this stage.
So we'll give a couple of minutes for questions if you have any. You can just put it in the question and answer at the bottom. Okay. If there are no questions, then we would like to thank Wade for this valuable information and his willingness to always help. And that goes for the whole investment team at Glacier Invest. Then we'd also like to thank you, our clients, for your continued support and your trust in managing your investments. If you have any questions and would like to schedule an appointment, please feel free to contact us on the information provided at the end of this presentation. And then lastly, I would like to remind you to please download our app. We believe that it can add value, and we are personally very proud of that. So once again, thank you for your time and thank you for joining us, and you must enjoy the rest of your evening. Good night.